You know that you can use ETFs to capture any swath of the market. So if you have a view on, say, energy or biotechnology, you can look to ETFs and see what products are there and how to use those in your portfolio. But perhaps you just want to build a solid model portfolio for your clients using ETFs. You can do that too. Today we're joined by three experts who are going to walk us through a couple of sectors of the market, but also how to be tactical in using ETFs. Welcome back to ETF Exchange.
There's a couple of things that are going on. One, M&A activity is at record levels, and two, sales of new products driven by FDA approvals. Last year was actually a record in terms of FDA approvals of new drugs, and those drugs, to many analysts' surprise, are achieving record levels of sales. A good example is Pharmacyclics Imbruvica. They were actually bought by AbbVie recently for $21 billion. Their drug, within just on over a year, achieved $1 billion in sales. There is Gilead's hepatitis C drug, which actually cures the disease. That is the best-selling drug launch of all time. So these drug launches are coming from biotech. And pharma is recognizing that and acquiring the companies. So very good fundamentals for the sector. Biotech is extremely speculative, and a lot of investors, when they buy individual stocks, they do get burned and they say, hey, biotech's really just not for me. I don't quite understand it. That's really why we created these biotech ETFs. What we've noticed is that if you own a basket of them, over time, a handful of winners will eclipse even a greater number of losers. And that's why if you looked at the sector overall over the last 5+ years, it's on an up trajectory.
It's been quite dramatic. Obviously, last year we had a 50% decline in the commodity price, which really translated into almost the same type of decline for pure energy stocks, which also include upstream MLPs. So both the production companies as well as the service companies had huge declines. And we're starting to see that right now, where production is slowing down as drilling is slowing down, incremental drilling is slowing down, and there has been a supply response. Gasoline demand is up about 4% year over year. And we anticipate that you're going to see that translate even more into prices during the summer, which is when people start really obviously driving and the consumption of gasoline will increase. We focus, which is on infrastructure MLPs. These are the ones that are less exposed to commodities. They've rallied a little bit, but we still see them significantly undervalued even on today's commodity price environment. Specifically, they're trading at almost a 6.5% yield, whereas the 10-year treasury is below 2%, and that's a 4.5% spread. And normally for these lower risk infrastructure companies, that's 2.5% to 3%. So we still see 10 to 15% upside for the infrastructure portion of the energy market. And so we think it's an attractive sector to look at.
What I've found in talking to clients is more often than not, what clients really want, regardless of whether they say they're aggressive, conservative, or moderate, what they want is they want relative returns in an up market, absolute returns in a down market. And the beauty about tactical products is they can't guarantee you're going to get that, but that's what they're designed for. Relative versus absolute returns. So basically what clients want is when the S&P 500 is going up, they want to get most, if not all of that. But when the S&P 500 is going down, they don't want any of those losses. So it's kind of funny where they'll say, well, I'm conservative, and then the market's up 30% and they're only up 10, and they're wondering why they're not up 30. So having conversations with clients in years where the market does better than maybe anything that's out there, that's always the toughest. It's easier for clients a lot of times to lose a lot of money when the market loses money. Misery loves company, but the hardest thing for investors to do is watch your neighbor get rich when you're not. So it really just comes down to a constant educational process of not chasing returns. The biggest mistake investors make over and over and over again is they're constantly buying high, they're constantly selling low because they're chasing returns. And as advisors, even though the path of least resistance is to allow them to chase returns, we've got to step back from that and be real coaches and really keep clients from making those mistakes.
So there you have it. A couple of views on specific areas of the market and a look at how to be tactical when using ETFs. Thanks for watching, and join us again on ETF Exchange.